Welcome to the Capital Blueprint. I'm Dominick Spisa, and today we are doing a full deep dive into GP/LP structures 101. This is episode 1 of the Capital Blueprint, the podcast where we break down the complex world of real estate fund investing so that you can raise capital with confidence, structure deals the right way, and build a portfolio that generates real, lasting wealth. I want to be direct with you right from the start. This show is not going to give you surface level platitudes. We are going to go deep. We are going to talk about the mechanics, the math, the legal frameworks, and the psychology behind the most powerful structures in real estate investing. And by the end of today's episode, you are going to understand general partner and limited partner structures better than the vast majority of people calling themselves real estate fund managers. So let's get into it. Let's start with the big picture. Why do GP and LP structures exist in the first place? The answer is alignment. Real estate at scale requires enormous amounts of capital, far more than any single operator can typically deploy on their own. At the same time, most high net worth investors and family offices want access to institutional quality real estate investments but have no desire to actually manage properties, deal with contractors, or navigate the complex legal and tax landscape of large-scale real estate. The GP/LP structure solves both problems elegantly. The general partner, the GP, brings specialized expertise, deal flow, operational capability, and typically a smaller but meaningful amount of their own capital. The limited partners, the LPs, bring the majority of the equity capital and receive passive income and appreciation without having to be involved in the day-to-day operations. This division of labor has driven the majority of institutional real estate transactions for decades. Every major REIT, every private equity real estate fund, every real estate syndication uses some version of this structure. It is, without exaggeration, the most important structural concept in real estate investing. Now let's break down what each role actually looks like in practice. The general partner wears many hats. They are the deal sourcer. They spend enormous amounts of time building relationships with brokers, operators, property owners, and market experts to find opportunities before they hit the open market. That deal flow advantage is often the GP's single most valuable asset. The GP is also the underwriter. When a deal comes in, the GP builds the financial model, stress tests the assumptions, and determines whether the risk-reward profile makes sense for their fund. This underwriting capability, the ability to accurately model income, expenses, debt service, capital expenditures, and exit scenarios, separates great GPS from mediocre ones. The GP is the capital raiser. They go out to their LP network, present the opportunity, handle the legal documentation, and close the equity raise. This is often the most time-consuming part of the business, especially for emerging managers who are still building their investor base. The GP is the asset manager. Once a deal is closed, they oversee the execution of the business plan, whether that is repositioning a multifamily property, executing a value-add renovation strategy, or stabilizing an underperforming commercial asset. The GP is responsible for making it happen. And finally, the GP is the relationship manager. They communicate with LPs regularly, provide financial reporting, distribute cash flows, and eventually navigate the exit or refinance of the asset. The quality of these LP relationships determines whether the GP can raise capital for their next fund, which is ultimately the lifeblood of the business. Now let's talk about the limited partner. An LP's primary contribution is capital. They are passive investors. They do not make day-to-day decisions about the property. They do not hire or fire property managers. They do not negotiate lease renewals. They sign a subscription agreement, fund their capital commitment, and then receive distributions according to the fund's distribution waterfall. But being a passive investor does not mean being a disengaged one. The best LPs conduct rigorous due diligence before committing capital. They review the GP's track record in detail. They read the private placement memorandum carefully. They ask hard questions about the underwriting assumptions, and they understand exactly how and when they will be paid. LPs also have certain rights that are spelled out in the fund's operating agreement. They typically receive quarterly financial reports and annual audited financials. They may have voting rights on major decisions like a sale of the fund's assets or a change in the GP. And in most well-structured funds, there are key person provisions and for cause removal provisions that protect LPS in extreme circumstances. Now let's talk about the economics because this is where most people get confused. In a typical real estate fund, the GP contributes somewhere between 1% and 20% of the total equity raise. The exact amount varies significantly based on the GP's capitalization and the fund's structure. Emerging managers often struggle to commit 5% or more of their own capital. Well-established firms may commit 10 to 20% to demonstrate conviction. The LP's capital contribution makes up the remaining 80 to 99%. This means LPS are taking the majority of the financial risk. In exchange, they receive priority in the distribution waterfall, meaning they get paid before the GP receives any promoted interest. The GP has three primary revenue streams. The first is acquisition fees. When the fund purchases a property, the GP typically charges an acquisition fee equal to 1 to 2% of the purchase price. On a $20 million acquisition, that is $200,000 to $400,000. These fees are meant to compensate the GP for the time and resources spent sourcing, underwriting, and closing the transaction. The second is asset management fees. On an ongoing basis, the GP charges a fee, usually between 1 and 2% of invested equity annually, for managing the fund's assets. On a $10 million equity raise, that is $100,000 to $200,000 per year. These fees cover the GP's overhead salaries, technology, office space, and reporting infrastructure. The third and most significant revenue stream is the promoted interest, also called the carried interest or the promote. This is where the real wealth creation happens for GPs who perform well. The promote is the GP's share of profits above a certain return threshold, the preferred return. In a typical structure, once LPS have received their preferred return on invested capital, and I will explain preferred returns in detail in a moment, the GP receives a disproportionate share of the remaining profits. The most common promote structure is a 20% promote. This means that once LPS have received their preferred return, the GP earns 20 cents out of every dollar of profit going forward, even though the GP may have only contributed 5 to 10% of the capital. On a successful fund, this can be extraordinarily lucrative. Imagine a fund that returns $100 million in total equity, representing a 2 times multiple on the $50 million capital raise. That is $50 million in total profit. After LPS receive their preferred return, the GP might earn $10 million or more in promote on top of their acquisition fees and management fees. That is the economic engine that drives the GP/LP structure. Now let's talk about the preferred return, because this mechanism is absolutely central to the GP/LP relationship. The preferred return, often called the pref, is the minimum annual return that LPS must receive before the GP participates in promoted interest. Think of it as the hurdle rate that the GP must clear before they start earning the big paycheck. In today's market, preferred returns typically range from 6% to 10% per year. Lower risk core investments might carry a 6% pref. Value add funds often target 8%. Higher risk opportunistic strategies might see prefs as low as 6 or as high as 10%. There are two types of preferred returns you need to understand: cumulative and non-cumulative. A cumulative preferred return means that if the fund does not generate enough cash flow to pay the full pref in a given year, the unpaid amount accrues and must be paid in full before the GP earns any promote. This is the investor-friendly version and is standard in most institutional funds. A non-cumulative preferred return means that if the pref is not paid in a given year, it does not accrue. LPS only receive the pref when cash is available. This structure is less common and generally less favorable to investors. Most well-structured funds also include a compounding feature, where the accrued preferred return compounds annually at the pref rate. This further protects LPS and motivates GPS to distribute cash flow consistently. Now let's walk through the distribution waterfall in detail. The waterfall is the order in which cash distributions flow from the fund to its stakeholders. It is, arguably, the single most important financial construct in the entire fund structure. A standard 4-tranche waterfall works like this. Tranche 1, return of capital. 100% of all cash flows go to LPS until they have received their full invested capital back. The GP does not share in distributions during this phase except to the extent of their own capital contribution. Tranche 2, Preferred return: 100% of remaining cash flows go to LPS until they have received their full preferred return on their invested capital. Again, the GP earns nothing on the LP's capital during this phase. Tranche 3: the catch-up. This is a feature that many first-time investors overlook. Once LPS have received their capital back plus their preferred return, the GP receives 100% of the next distributions, or a very high percentage, like 80%, until the GP has caught up to their promoted interest percentage. Without this catch-up provision, the GP would effectively be earning less than their stated promote on total profits. Tranche 4: the split. All remaining profits are split according to the promote structure, typically 80% to LPS and 20% to the GP. This continues until the fund is fully liquidated. Let me give you a concrete numerical example to make this real. Imagine a fund raises $20 million from LPS, with the GP contributing $1 million for a total capitalization of $21 million. The preferred return is 8% annually. The promote is 20%. After 5 years, the fund sells its assets and distributes $42 million total, 2 times multiple on invested equity. Here is how the distribution flows. First, LPS receive their $20 million of capital back. Second, LPS receive their cumulative 8% annual preferred return on $20 million over 5 years at 8% compounding. That is approximately $29.3 million. But wait, we only have $42 million total, and we have already used $20 million for return of capital. That leaves $22 million for the remaining tranches. $22 million is less than the full compounded preferred return of $29 million. So in this scenario, LPS receive all $22 million remaining. The GP receives nothing in promote because the preferred return was not fully satisfied, and the GP only earns their management fees and acquisition fees. This example illustrates a crucial point. Preferred returns are real protection. GPS only get rich if their investors do well first. Now let me run the scenario where the fund does perform well. Same structure, but the fund distributes $63 million total at 3 times multiple. LPS receive their $20 million in return of capital. LPS receive their full 8% compounded preferred return of approximately $29.3 million. The remaining $13.7 million enters the catch-up tranche, where the GP receives 100% until their promote is satisfied. Once the catch-up is complete, remaining profits split 80-20. The GP might earn $2 to $3 million in promote on this scenario, on top of their acquisition fees and management fees. This waterfall structure is elegant because it creates genuine alignment. The GP only wins big when LPS win big. Now let's talk about the legal structure that governs all of this. GP/LP funds are typically organized as either Delaware Limited Partnerships or Delaware Limited Liability Companies. Delaware is the most common state of formation because its corporate law is the most developed and well tested in the country. The fund's primary governing document is either the Limited Partnership Agreement for LP structures or the Operating Agreement for LLC structures. This document is the Bible of the fund. Every right, obligation, fee, and procedure is spelled out in detail. When you are reading a fund's legal documents, there are several provisions you should pay particular attention to. First, the capital call provisions. These describe when and how the GP can call capital from LPS. Most funds have a commitment-based structure where LPS commit to a total amount but only fund it as capital is needed. The GP issues capital call notices, typically with 10 to 30 days notice, and LPS must fund the called amount within that window. Failure to fund a capital call can result in significant penalties, including dilution of the LP's interest. Second, the removal provisions. These describe the circumstances under which LPS can remove the GP. Most funds allow for removal for cause, meaning the GP has committed fraud, gross negligence, or a material breach of the fund documents. Some funds allow for removal without cause, but this is less common and typically requires a supermajority vote of the LP interests. Understanding these provisions is critical because it defines the practical limits of LP protection. Third, the key person provisions. These are triggered when one or more of the fund's key principals, typically defined by name in the fund documents, cease to be actively involved in managing the fund. Upon a key person trigger, The fund typically enters a suspension period where no new investments can be made and LPS may have the right to wind down the fund. This provision exists to protect LPS from the scenario where the people they invested with are no longer running the fund. Fourth, the reporting requirements. The fund documents should specify exactly what reports LPS receive and on what schedule. Industry standard is quarterly and audited financials and an annual audited financial statement. Some funds also provide monthly investor updates or access to an investor portal where LPS can view their positions in real time. Fifth, the amendment provisions. These describe how the fund documents can be changed. Most funds require a supermajority vote of LP interests to amend material terms. Be wary of any fund where the GP can unilaterally amend the operating agreement. Now let me shift to some practical advice. Depending on which side of the table you sit on, if you are an emerging GP raising your first fund, here are the most important things to get right. Number 1, build your track record before you raise. LPS invest in people, not just deals. Before you approach institutional investors or high net worth individuals, document every deal you have been involved in, even deals where you were a junior partner or a co-sponsor. Quantify your contribution and your results. A clear, well-documented track record is the most powerful marketing tool you have. Number 2, structure your fees fairly. Emerging GPS sometimes try to maximize fees to generate income while they are building their platform. This is a mistake. LPS talk to each other. If your fees are aggressive and your performance is mediocre, your reputation will suffer quickly. Start with market rate fees, deliver strong returns, and you will have no trouble raising your next fund at premium terms. Number 3, commit meaningful capital alongside your LPS. Nothing builds LP confidence faster than seeing the GP's personal capital at risk. Even if you can only commit 1 or 2% of the fund, do it, and make sure your LPS know about it. It signals that you believe in your own strategy. Number 4, over-communicate. Send more reports, not fewer. Call your investors when the news is bad, not just when it is good. The GPS who build enduring LP relationships are the ones who create a culture of radical transparency. Problems happen in real estate: construction delays, unexpected expenses, market downturns. LPS understand this. What they cannot forgive is being kept in the dark. Number 5, hire a great fund attorney from day one. The cost of having a sophisticated real estate fund attorney draft your documents is not optional, it is essential. A well-drafted operating agreement protects you from disputes with LPS and sets clear expectations for everyone involved. Do not try to cut corners here. Now, if you are an LP evaluating a fund opportunity, here is your due diligence framework. Step 1, evaluate the operator. Not just the deal. Who are the GPS? What is their background? How long have they been investing in this specific asset class and geography? Have they navigated a downturn? What does their track record look like on a risk-adjusted basis? And critically, talk to their previous investors. Ask for references and actually call them. Step 2, scrutinize the underwriting. Request the financial model and review the assumptions in detail. What cap rate are they buying at? What cap rate are they projecting for the exit? What rent growth assumptions are built in? What occupancy assumptions? What are the projected capital expenditures? Conservative underwriting, where the GP stress tests for downside scenarios, is a sign of intellectual honesty. Rosy projections with no sensitivity analysis should raise red flags. Step 3, understand the capital structure. How is the deal financed? What is the loan to value? Is the debt fixed rate or floating rate? When does the debt mature? The capital structure directly impacts the risk of the investment. A highly leveraged deal with floating rate debt maturing in 2 years carries far more risk than a conservatively leveraged deal with long-term fixed rate financing. Step 4, read the fund documents. Not just the executive summary. The PPM and operating agreement contain the terms you will actually be bound by. If there are provisions you do not understand, ask your attorney or ask the GP to explain them. Never rely solely on the investment summary or slide deck. Step 5, understand your liquidity. Most real estate funds are illiquid. Your capital will be tied up for the investment horizon, which could be 5 to 10 years. Make sure this aligns with your overall financial plan. Do not invest capital that you might need in the short term. Step 6, evaluate the alignment. Does the GP have skin in the game? Are the fees reasonable for the strategy? Does the promote structure reward the GP for genuine outperformance, or does it allow them to earn outsized compensation for mediocre results? Let me close with a few thoughts on the future of the GP/LP structure. The structure itself has been remarkably durable. It has survived multiple real estate cycles, the global financial crisis, the COVID-19 pandemic, and dramatic shifts in interest rates. That durability reflects the fundamental soundness of the alignment mechanism at its core. What is changing is the democratization of access. Regulation plus and regulation crowdfunding have lowered the accreditation requirements for certain fund structures, allowing non-accredited investors to participate in some funds. Technology platforms are making it easier to manage hundreds of LP relationships efficiently, and the rise of investor portals and automated reporting is raising the baseline standard for transparency across the industry. For aspiring GPS, this means the bar for quality is rising. Investors have more options and more information than ever before. The GPS who will win are those who combine genuine operational expertise with institutional quality investor relations. For LPS, this democratization is a double-edged sword. More access means more opportunity, but it also means more complexity in evaluating options. The due diligence framework I outlined earlier is more important than ever. Here is your action item for this week. Whether you are a GP or an LP, I want you to take one concrete step toward deepening your understanding of this structure. If you are a GP, pull out your fund documents or your draft term sheet. Read the distribution waterfall section carefully. Can you explain exactly how distributions will flow under three different scenarios: a break-even exit, a moderate success, and a strong success? If you cannot run through those scenarios fluently, you are not ready to explain them to your LPS. If you are an LP, request a sample PPM from a fund you have been evaluating or one you are already invested in. Read the governance provisions. Identify the key person provision, the removal for cause provision, and the reporting requirements. Understanding these provisions is not just academic, it is your primary protection as a passive investor. The more you understand these structures, the better decisions you will make, whether you are raising capital or deploying it. Thank you for listening to the Capital Blueprint. I am Dominick Spisa. If this episode gave you clarity on GP/LP structures, I would love it if you shared it with one person in your network who is exploring real estate fund investing. Leave us a review on Apple Podcasts or Spotify. It genuinely helps us reach more investors and operators who are building serious real estate businesses. Subscribe wherever you listen to podcasts, and join me next week when we go deep on preferred equity versus mezzanine debt, two structures that are often confused but have dramatically different risk profiles, rights, and returns. You will not want to miss it. Until then, keep building your blueprint.